Good weekend. Ira Epstein with your weekend edition of your financial market wrap-up. And this wrap-up is for Friday, and we are now sitting here on June 20th, 2025. Well, as you can see behind me, the stock market as a whole, the indices down today. Metal markets got hit pretty hard today. Silver especially took it on the chin. It was down probably the most on a relative basis. When we look at the dollar index down, mixed bag in the currency markets. And as we come over here into the energy markets, well, I think you can see that what they are trying to do is still stay somewhat elevated. Now, we saw European members met in Geneva with Iranian ministers. And as usual, we need more time. We'll meet again. We'll talk about it. That isn't going to work. That's all that they ever say, and then they come back, and it's always, we're not giving up uranium enrichment. So why do these meetings break off is beyond me. Why they're taking place is beyond me, unless somehow there's going to be a breakthrough. That could be done 1, 2, 3. All they have to do in Iran is say, we will give up uranium enrichment. We will move things to Russia. Russia can send us the product that we need to do our commercial development, and this game's over. It's pretty simple. And Russia's offered it, so I'm not making this up. They don't want to go down that road. The president today said, and he defined as 2 weeks that he gave them the other day, and he said that's the maximum time. I don't know what that means, because the president says one thing, does another. So don't read more into that than it is. Remember, he left the G7. In 48 hours, something big was going to happen. Nothing big happened. So he says a lot of things, and you've got to take it with a grain of salt. Down still in the in Bitcoin a little bit here. All right, what about news that we have coming up this week? You've got S&P Global Group. They're going to release their U.S. preliminary June manufacturing sector PMI. That'll be at 8:45 on Monday. At 9 in the morning, you're going to get existing home sales data for May. That'll be an interesting number. We have a number of Fed members speaking. I think middle of the week, if I'm right, Fed Chair Powell goes to Congress and speaks before them to give them another update as to where it's at. But with the meetings we've had, that's about all you're at. A lot of Fed speakers today were on. I was listening to Mary Daly, who I think has a pretty good handle on it. She says, we just don't have enough data yet. Show me that something's weakening that needs the Fed help to cut rates, fine. But we don't know the impact of inflation. And that becomes the problem, and none of us have seen that. Maybe this is it. You know, it certainly hasn't worked its way through to dramatically higher prices. But as we start getting the PMIs, everybody will be looking, is this the beginning? So let's take a look at the chart action and see just what we do have. When you take a look on a monthly chart of just closing prices, you're near the all-time high. I was listening to Carter Worth on CNBC, and he had done a study, and he said that it is very common, he's seen this over and over, when you get a big break where a market drops 20% and rallies back and nearly recaptures everything and doesn't go through those highs, that the market spends a bit of time playing around with it, but it often, these aren't my words, it's what I heard him say, I thought, the market does succeed in going through it. So, you know, we've got summer doldrums coming. We're going to have 100-degree weather hitting big parts of the United States. The markets can afford to be a little bit quiet right here. I don't see that problem. The next thing I look at is on the S&P itself on the weekly chart of closes. You're staying over the 18-week average, so the bias stays up in the market. These are the highs that we've had on a weekly chart. You can see you've come here and you're churning. And you began the churning about 4 or 5 weeks ago. You got up into this level and you're just sort of hanging here. But you can see where the resistance part comes in. When you put the swing line on the chart, you see that you've got higher lows, higher highs. Remember, what a swing line is in plain English. You have a current chart today. There's 5 rules that I look at to see, does it make a higher high and lower low, an inside day, a higher high that goes lower, a higher high that goes higher. It's 5 rules. And then the line draws itself according to the rules. And I'm always looking to see, are you trending? Because the definition of a trend in an uptrend's higher lows, higher highs. Where's the balance to it? Where's the filter on it? I use the moving averages. And this is the 18-week moving average, the 100-week, and the 200. Well, this chart is certainly lined up in a bullish formation. If you go study moving averages, almost every analyst that knows how to use them is going to tell you in the shorter terms over the medium term over the longer term, you have a bull market situation in moving averages, and all you need is price to stay over them. That's what you've got. Support's all the way back at 57.28. Don't know if you'll get there. That's a 300-point break. It's sizable. When we take a look at the resistance, 62.45, 75, that's the Bollinger Band, and that number's slipping. And it will slip if the market can't get up and start making higher highs than it did 2 weeks ago. Not this week, the week before. Without that, how the math will work on this, it'll start coming down a bit. Last but not least, you're overbought. The slow stochastics, both numbers are over 80, but they're not going sideways over 80 for several sessions. So the market's got a bit of a problem there. When we come to the Dow, this is your contract high on the futures. The market keeps hitting the 18-week average. It too is overbought. The trend on the swing line is up. And the market stays that way unless you get underneath now 41,651. If you take that out, and from where you're at right now, that's a good amount of points. But if it takes it out, you open the door to come back down here. Now the question is, what is the market going to do? I think the bulls are in control of that market. The bulls are in control of the NASDAQ, higher lows, higher highs. This is still the leader and the first one that acts like it wants to go for the contract highs. And that's because the tech sector has been the strong sector so far. That doesn't mean there's rotation not going on. There's plenty of rotation going on in this market, but the tech has led the market up. In the Russell, this market is also bullish. So I have been the one that hasn't been friendly, but you don't argue with City Hall. You generally don't get anywhere. You're over the 200-day average. You're over the 18-week average. Did I say day? These are weekly charts. And the 100-week. So the green, the gray, and so on. And they are not lined up completely bullish because you still have the 18-week underneath the 100-week, the green. So it's there as support, but not the ideal layout. In the DAX, you still have an embedded reading. So this is a correction in a bull market, not the end of the bull. In order for me to say that this leg is over, the red line, which is now at 85.98, would have to close under 79 at the end of the week. Hasn't done it yet. When we come over and look at the next chart, the 30-year bonds is still in a downtrend. So what you have here is a pattern of lower highs and lower lows. The market is oversold. I don't think the smart money is deploying new money in the market on the short side, but it's certainly not acting at this point like it wants to get up and go. If it does, it's got to close over the 115.8 level. Hasn't done that yet. In the 30-year bonds, you'd have to get up here doing the same type of thing, 10-year rather. Right here, you'd have to get back and stay over the 111.12 area. Haven't been able to do that. Then we get to the dollar index, which I think is still very bearish. Lower highs, lower lows. If you take a look, this market's right by the lows of the whole move. I'm still pegging, I know this sounds crazy to people, the 90 level. So I think that you have problems here. In the eurocurrency, if you can keep this embedded reading working, both numbers, as you can see here, this week both were over 80, last week both over 80, and the week before. So until you close under 79, I think the pros will be using breaks in this market to buy it, and I think they'll bail at the end of the week if you're under a 79 reading. In the Canadian dollar, same thing. So there's a story. Most of the currencies are still bullish against the U.S. dollar. The Japanese yen, even with all this pullback, has stayed over the 18-week average. Now, it's not in a, how do I put this, an ideal uptrend. While you have the higher lows, you got lower highs. So you got a market that's coming in like that with you. And momentum's been coming down. Now, what they're doing in Japan, and I wrote about it today, they're changing the time frame for how they're working at this point and going to come out with longer term debt. They're doing away with it. They're moving to the shorter term, which benefits them to one degree when interest rates are this low. As long as they don't go a lot higher, they're okay. But if they go a lot higher, then they're caught in a quandary like the United States, where a lot of people were going into short-term interest rates because they were so low, and they didn't take length. And now that interest rates have gone higher, as that debt comes up, well, now you're replacing it with length, and that's always ugly to do because now you got a real problem. You got much higher rates. In Bitcoin, okay, sideways action, not looking bearish to me on the weekly chart. The most I'm seeing is maybe you can get back to the 18-week average on this formation. I don't see a problem yet in that market. The differential between Brent and WTI probably got stretched out last week, not this week, the week before, and you're getting a good bounce in the market back to 2.08. I'd be a little bit nervous here. Whenever you come up to the 100-week average and a Bollinger Band together, it's often an area you run into problems. And you're right at that number right now. You are overbought. The trend is clearly up. Obviously, this market would see the bottom or the rug pulled out from under it if Iran were to give up and say, I'm giving up the uranium enrichment, come and get it. Game would be over. This market would go, I think, sinking down. I don't expect them to do that. I'd love to see that so that all this strife can end. Higher lows, higher highs. You can see where you're at here. You're overbought there too. Gasoline. Well, you got July 4th coming. Don't go picking tops. The big demand, the gas stations have ordered. They're waiting for the fuel to come in. Prices should go up right in front of that. They typically do. We're running I think it was AAA who said they expect gasoline in the U.S. to be about a quarter a gallon lower in price than it was a year ago. So you put this together, you get a game plan, and we offer a lot of this. You know, a lot of what you hear me espousing here, it's there, and you can work with it. You get me talking about courses, okay? Do you know how a trend might continue? Do you know what an outside week or an outside day is? It's so important because it's a continuation or an end of a trade pattern often. Nothing's all the time. I put together 9 video chapters for you. We give you my charting software to work with, and we give you access in the morning to my 2 videos for the futures and the spiders and the ETFs. You put it together, you get a game plan, learn to work with it. Go to iraepstein.com, the courses, it's that simple. There's icons up here and right here. I'll catch up with everybody in the other videos this weekend, and I'll see you come Monday morning. Have a great weekend.